We're going to move now into the international stock market. As you can see, the S&P was used mostly in the U.S. stock market. The U.S. was used mostly in the S&P was used mostly in the U.S. stock market, which is really what we use predominantly in our portfolios. The most popular index is the Dow Jones Industrial Average Index, and it's a equally weighted index, 30 stocks. The S&P has 500 stocks, market cap weighted index, and we feel it probably gives you a better idea of the U.S. stock market as a whole. The Dow Jones is nice because everybody likes to quote it, but we use predominantly the S&P. So now we're going to go into the international and emerging markets, and I think this is you, Marty.
That's me.
Marty.
So, with emerging markets, as Steve pointed out, last year was not a great year. This year's not starting out to be a good year. Sometimes that performance for an asset class can underperform, in particular with emerging markets where it's more volatile, for a number of years. And it's important as investors to understand that. And I think as human behavior is, after a year or two of that, you're like, I want out, I don't want any more. And that's really the exact time to be overweighting that asset class. And one thing we want to communicate to you is, what does emerging markets and particularly the global economy mean to consumption, and what does it mean to global economic growth? And the slide on the left basically shows you can see the US, Japan, and South Korea, where the GDP per capita, so that's what is the GDP for each one of us in that country. And on the bottom line is the urbanization ratio. So that's basically saying how many people live in an urban area. And you can see that in the US, Japan, and South Korea, a lot of us live in urban areas, very high GDP per capita. China and India, which are the two emerging markets that are shown there, you can see that they are just in the infancy of becoming more urban instead of agricultural-based economies, and just in the beginning of GDP per capita. So very nominal elements in that respect. So when we look at it from an investment perspective, as we make adjustments in our emerging market holding, we're looking at, okay, where is that growth going to come? And there's a commodity element that we mentioned with emerging markets, but there's a lot of other areas too. In particular one is the consumer market for just everything from food to healthcare to toothpaste. So that at some point really starts to grow and it becomes a big revenue item, both for companies that are located in emerging markets, also with US companies, right? So, we talk about how are US companies making so much money if GDP is only growing at 2%. Well, if a lot of their sales are coming from emerging markets and other areas, that provides profits for them, and that can add to the growth. So, and we want to communicate to you the importance that we think emerging markets from a long-term perspective, not just this year, long-term are going to provide to portfolios and growth. And really that shows you there, so that graph on the far right basically shows you how now the emerging markets, which is the bottom, is the purple, has shot up past the US consumption of global, as a percentage for global consumption. And that is only going to continue. So we, as investors, we want to make sure we have exposure to in that for your portfolios. Next.
So this slide here starts talking about the peaks that we saw in 2007, both internationally and in the US. And you can kind of relate it back to some of those slides that my father had gone through at the beginning that were kind of the roller coasters. We saw the US large caps, peak, go back down to a trough, and come back up where they've outperformed what the 2007 peaks were. That's on the last bar where the US, where now they actually are above the peaks and would have to retreat a little bit to reach that 2007 level. From an international perspective, we still saw from that graph that international stocks still have some room to grow. And if you look at the top, we start with Italy and Russia. To reach their 2007 peaks, they would have to gain roughly about 180,000 or 180 percentage points of where their valuations are right now. So they're much under the peaks. Doesn't mean that they're all great investments. We definitely see certain areas of emerging markets and certain areas of the developed Europe be better investments than other countries. But here we see, Spain, which we made some moves into, they're about half of where their 2007 peak was. China's still well below it. France, Brazil, Europe, not including the UK, and some emerging markets as a whole. So we see that there's still a lot of room to get back to those 2007 peaks, but I think it is important to analyze each country on a country-by-country basis to make those right decisions in terms of where is their value and what economies and which asset classes have room to grow. And we see them being positive investments going forward. The top right is the international index, so those are all international developed countries. Right now, they're about 20% under the 2007 peak. Bottom right, we have the emerging market index, and they're about 18 percentage points under the 2007 peak. So we do see some value here and some opportunities to invest. Next slide, please. And this is great. I love these charts on the right. I'm going to focus on those two. We have, on the top right, we have the weight and MSCI All Country World Index. So that's measuring the market cap for certain countries, certain regions. What we have here, the United States makes up about 50% of the world market cap of all securities. We have Europe, not including the UK, about 16%, the UK about 8%, emerging markets only 11% of what their shares, their outstanding, their market cap is in this World Equity Index. If we go down to the bottom right, you see emerging markets make up over 50% of the world GDP. The United States only makes up about 19%, so they almost, in a sense, flip what their GDP is compared to what their market cap weight is. So we see this, we like to use this as an indicator that, it's a good thing to be in some of these, whether it's emerging markets, whether it's developed Europe, whether it's an international stock, because with the global economy growing like it is now, these are areas that we want to be invested in a diversified portfolio. And there's, as we see what the growth is, it's definitely an area that you want to be in to round out that equity portion of your portfolio. Next slide, please.
Next. So Steve mentioned a lot earlier about fixed income and our concerns with it, and we'll just give you a few additional highlights on that space. So what this does is it looks at 3 different indices. The S&P 500 during the tech bubble, the Russell 1000 value during the financial bubble, and the Barclays Bond Index today. And the important element of this is, as many of you know, for most of our fixed income, we use active management, and we're also very tactical in our allocation to it. And there's a specific reason that, and this is true in a lot of cases where they have a bubble that's occurring. If you look back to the tech bubble with the S&P 500, through that growth in the tech bubble, the tech element became 29%. So you have this index that now has a huge component of that index that is from a bubble element, so a financial piece that really has a lot of growth and maybe is overvalued. Same thing the Russell 1000, right? So during that period of time, financial companies were really taking off, and they became a huge component of the Russell 1000. So another situation where that index was basically in a problem situation if that bubble were to pop. Same thing with the Barclay Aggregate Bond, right? So through that bond bubble that Steve was talking about over the past 30 years, it's become a huge part of that index. And so from our perspective, we really got to be careful as you're getting allocation, in particular just through a straight index like that you're not overweight to treasuries, which actually could be really impacted by rising rates. Next.
So this just gets into the role of bonds in a portfolio, and we've been talking a lot about where interest rates are, where we foresee them going in the future. I mean, we've been on this 30-year bond bull market, and we've been weary of where interest rates being at an all-time low, that they really have nowhere else to go but up. And so that's going to affect the valuation of bonds inversely, unfortunately. So value of bonds may go down in the near future, but as we've seen in the first 5 weeks of this year, as equities have been going down, bonds have actually been performing quite well. And so it's important to remember that there is a purpose of these in any portfolio, especially when it comes to whether it's income, whether it's just diversification from equities. They make up, whatever it may be from a risk tolerance perspective. There is a reason, there is purpose at bonds. Even if we're not as bullish on bonds as we are equities, there's a great reason to have them as part of your overall diversified portfolio. Next, please. All right, I love this slide here. It gets into, we hear the question all the time, when's inflation going to finally take off? We've seen the Federal Reserve just pumping money into the economy between the quantitative easings, $85 billion a month. It's dropping now, but we've seen quantitative easing 3 has just been putting a ton of money into the economy. Why aren't we seeing prices rise? Why aren't we seeing inflation go up? And a lot of this has to do with the phrase, the velocity of money, which gets into how quickly is a dollar spent in our economy. And right now, the velocity of money is at an all-time low, or pretty close to there. We see a couple of different factors that are playing into this. One is we have the U.S. bank deposits, which is the maroon graph. Right now, bank deposits are trending upwards, and we're seeing, and we go back a couple of slides too, where we had the deleveraging, whether it's U.S. households, whether it's U.S. companies. A lot of folks are bringing down their debt levels and saving more money than they were saving in the past. So that's slowing down that velocity of money. We also say U.S. bank total loans and leases. Since the recession started in about 08, 09, we've seen more bank regulations, and we've seen stricter limits on what banks can lend out. And because of that, there's a lot less, even though money's being pumped into the economy, it's not being, through the banks, it's not being lent as much as it was in the past. So right now, there's not a lot of money being spent, and that's keeping inflation at the levels that we've seen over the past couple of years.
The other two elements that if they're not increasing in price or in magnitude, you're not going to have inflation. One is labor, right? So with unemployment where it is, you're not going to have increases, dramatic increases in wages, and that's going to limit inflation. And the other element is commodity prices. So if commodity prices are declining, then it's very difficult, it's very unlikely that you're going to have high inflation. So those three elements, as long as they exist to a certain extent, you're probably going to have fairly low inflation. And even if the labor markets continue to improve, again, that inflation is going to be fairly moderate for the time being. But with that said, it doesn't mean that we're not at least thinking about inflation and what it could happen if it comes in. Because at some point, if banks start lending, if labor markets become tighter and commodity prices increase, that inflation can come back pretty quickly. So as we look at portfolios, we're considering what do we need to have in there to protect in case that happens. Next. So we mentioned commodity prices, and certainly, what we saw in the last 10 years, what's being described as the commodity super cycle, right? So commodity prices really took off. And with emerging markets really growing, you had a lot of demand for those commodities and really a limited supply in many areas for many commodities. So the prices of commodities shot up. And with the recession in 07, it really was a financial crisis. It was a financial crisis with oversupply in residential housing. But it was also a commodity bubble, right? So we had huge commodity prices really shot up to the point where if you looked at them, they're very comparable to what they were in the 70s. They caused us to have stagflation. So really a situation where commodity prices shot up, but now in a sense you can see that separation from, in this situation you have the yellow orange line is the commodity prices and the maroon line is the S&P 500. So now you're getting the two delinking. And as Ryan will explain, that's common. That is not unusual for that to happen from a historical perspective. Next.
So this gets into kind of the historical graph of how commodities have performed over, this goes back to the 1900s, so 100 plus years compared to how the Dow Jones Industrial Average has performed. And as you can see the top graph, that's the commodity component. The shaded areas are all the bull markets. The lighter white areas are secular bear markets in the commodity index. So you can see as it lines up with the Dow Jones Industrial Average, it's almost like a checkerboard. As we see stocks rise and we see bull markets in the US, we've seen commodity prices either go down or stay pretty flat. And that's been historically pretty close to the graph over 100 plus years. So as we continue to feel that there is a secular bull and a bull market still on the horizon, less prone to want to get into commodities and see their outlooks not as rosy and bullish.
And with regards to the stock market, see how they played this out? With regards to the stock market, the other question, take the Great Depression out of the equation, which was here. This goes back to 1900. You look at the trend of stock prices. I always hear more times than not, the stock market's at an all-time high. It's time to get out. And I always say, well, thank God it's always at an all-time high. For the most part, as you can see over the last 100+ years, the stock market is always at an all-time high. It takes a little breather, but the stock market as an asset class is still the best performing asset class out of all asset classes. There's risk that comes with it, but long-term the risk is low. The volatility is always there, but as I said earlier with the fixed income slides, there's also volatility in the bond market as well. Next, please, Stacy.
That's a good lead into this slide. So this basically shows you in the maroon line the performance of the S&P 500 relative to gold. So what you can see, the gold is, they just put it flat at $100. And in times where you're moving up with the maroon line, that means the S&P 500 is outperforming gold, relatively speaking. And you can see that we've had a period of time since around 2000 where gold outperformed the S&P 500, relatively speaking. But we had that period of time in a number of different occasions back to 1912. And then it's after that has lapsed into a period of time where the S&P outperforms gold, relatively speaking, over that period of time. And I think this is very important too, because we constantly have questions on gold and, should we have in the portfolio and why is it there? And, if you look at this, since 1912, that's the S&P outperforming gold over that period of time. So anybody who looks at this would say, why would I ever own gold? All right, because if you look over the long term, the S&P is going to way outperform that asset class. So that's definitely our perception of having gold in our portfolio, which we don't. So next.
This gets into the importance of broad diversification. I think it's perfect timing with this week and some of the figures that came out today. We always try to talk to clients about being disciplined, think about the long term, and have a long-term perspective. If you look at yesterday, we had a negative jobs number come out in the private sector. Markets took a hit. Today we had a positive number come out in the unemployment claims. So the markets take off, which was perfect timing for today's event. And now tomorrow we have the new jobs number coming out, and so we'll see how the markets react to that. But there's 3 different job numbers that have come out in the past 3 days that may potentially affect the markets one way or the next. We always try to say, stay disciplined, have that long-term approach, rebalance as we do every so often. You look here, we have the asset allocation. We have a number of different asset classes that make up this graph. We have REITs, emerging market equities, developed international equities, small cap stocks, large cap, bonds. You see over time, a diversified portfolio performs very well, relatively speaking, to the other asset classes, but it limits some of that volatility. And that's really our methodology and our perspective when we're looking at building a portfolio and including different asset classes, is that over time, we're trying to minimize that volatility, but at the same time, maximize risk-adjusted returns. Next slide, please.
I think this is a really interesting slide to give you an idea as to where we think some of these different asset classes that we invest in, where they stand in their own cycle and where they stand versus the economy. So we'll start off with the U.S. Treasury bonds. So really, that's something that you want to have in the beginning of a bear market, right? So if things are really bad, U.S. Treasury is going to do well, and definitely not something we want to really have much of an allocation to, given our concerns over interest rates. If you move next to emerging markets, really, as we said, from a long-term perspective, we want to have allocation. As we look at our holdings, making adjustments to try to find particular emerging markets that we may see some growth out of, but at the same time, from a long-term perspective, we may actually be a little bit early to the game in that asset class because we may see a little bit more volatility over the next year or two. Then if you look at the Eurozone, really, as we mentioned, really right at the beginning of a recovery. And as you recall, if you're invested in March of '09 into the market here, That's a great time to be invested. So that's our perspective as to why we want to have allocation to Europe and even developed international. U.S. corporate bonds and U.S. equities, you can see that we still think we're really just out of the beginning or the ends of the recovery and into the bull market. So, we have decreased exposure. Our view on that is, maybe over the next 2, 3, 4 years, we may actually see us decrease exposure to equities. But we want to make sure that we're doing that at a time where we think we're more at the end of the business cycle, more at the end of the market cycle than we are now. And there's going to be a lot of things that help us make that decision. But as we mentioned, we feel pretty comfortable that we're more more in the middle area versus the end of either the economic or the market cycle. Next. So if you can read all that, next. And then we'll open up to questions.